Hi everyone, my name is Joyce and I work in the Public Access and Education team at the Reserve Bank of Australia. This video provides a brief summary of current economic conditions as published in our November Statement on Monetary Policy. Let's start off by looking at the global economy. The global economy has continued to recover from the COVID-19 pandemic. Vaccination coverage has continued to increase in many countries, enabling social distancing restrictions to be relaxed and economic activity to increase. Although this has led to an increase in COVID cases, hospitalizations and deaths have remained much lower than earlier in the pandemic. To date, the improvement in economic activity has generally been quite uneven between many advanced and emerging economies, largely because of differences in vaccination rates, health outcomes, and household and business finances. We can see the unevenness of the global recovery in this graph, which compares GDP to where it was in December 2019, or pre-COVID. The grey circles show the change to December 2020, and the red triangles show the change to September 2021. Where the latest data are not yet available, the chart shows a forecast, as is the case for Australia. If GDP was the same in September 2021 as it was in December 2020, then the red triangle and grey circle would overlap. An example of this is Australia. Looking at the length and direction of the red arrows, we can see that activity has picked up in economies where restrictions have eased following strong vaccination campaigns. For example, in advanced economies like Taiwan, South Korea, and the United States, shown in the left panel of the graph, there have been substantial increases in GDP since December 2020. Elsewhere, including in many emerging economies, a resurgence in COVID-19 infections and renewed measures to contain the virus have hampered the economic recovery. Vietnam is an example of this, where you can see GDP has fallen sharply since December 2020. In Australia, we saw renewed waves of COVID-19 in New South Wales, Victoria, and the ACT following the outbreak of the Delta variant over the past few months. In response, governments introduced stay-at-home orders that meant around half of Australia's entire population was placed under significant restrictions. This is shown in the graph by the green, blue, and pink bars to the right, which reflect the lockdown populations in those states and territories. In contrast to the experience during the 2020 lockdowns, business and consumer confidence have held up relatively well this time round. Businesses have also indicated in the bank's liaison program they largely considered the recent lockdowns to be temporary and expect a strong economic recovery. Lockdowns have now largely been lifted, and timely data show that people are moving around the community much more in New South Wales and Victoria, shown in the blue and the green lines, as they recommence activities such as working from the office, shopping, and eating out at restaurants. It is expected that the increase in mobility will be associated with a boost to consumer spending and investment. Unsurprisingly, the recent wave of COVID cases and associated lockdowns means that we expect economic activity to have decreased sharply in the September quarter. The purple line on this chart shows how GDP has actually evolved throughout the pandemic, and the pink line shows how the RBA expects conditions to evolve over the next few years, or over our forecast period. Prior to the recent outbreaks of COVID-19, the economy had grown to be 1.6% larger than its pre-COVID level. Looking forward, GDP is now expected to decline by around 2.5% in the September quarter, meaning it will dip temporarily below its pre-pandemic level. This dip will mostly reflect a reduction in household consumption and business investment, since those expenditure opportunities for households and firms have been restricted by lockdowns. A rapid bounce back in economic activity is expected over the December quarter and beginning of next year, as social distancing restrictions are further eased in line with increased vaccination rates. The improvement in economic activity is expected to be fairly broad-based across household consumption, business investment, and exports. By mid-2022, the economy is expected to be back on its pre-Delta path. Let's take a closer look at household consumption, which is the largest component of GDP, accounting for around half of all spending in the Australian economy. Household consumption increased by 1.1% over the June quarter. This was largely before the major outbreak of the Delta variant of COVID-19 and associated lockdowns. We expect consumption to have fallen sharply in the September quarter, consistent with the widespread lockdowns that were in place during the quarter. A strong recovery is expected in the near term on the back of increased spending opportunities, such as on travel and eating out at restaurants. Growth in household income and household net wealth, and a decline in uncertainty related to health and economic outcomes are all expected to provide support to household spending over the next couple of years. Now turning to the labour market. The recent Delta outbreak and associated lockdowns has also had a negative, but largely temporary, impact on the labour market over the past few months. Many workers have had their hours reduced or have been stood down, particularly in those industries most affected by social distancing restrictions, such as accommodation and food and retail trade. As a result, for Australia as a whole, employment decreased by 2% and total hours worked decreased by 3% between June and September this year. The green and blue lines in the chart show the declines in employment and hours worked have been concentrated in New South Wales and Victoria, where lockdowns and social distancing restrictions have been most pronounced. In other parts of the country, shown in the yellow line, there have been minimal disruptions lately. More recently, there have been some signs of improvement in labour market conditions. Hours worked ticked up in New South Wales in September and will likely do so in Victoria going forward now that the Melbourne lockdown has ended. Data on job advertisements also showed a strong increase in hiring intentions in New South Wales and Victoria from the second half of September, ahead of the easing of lockdown restrictions. Despite the decline in employment and hours worked over the past few months, the unemployment rate fell to 4.6% in September. The reason for the lower unemployment rate is that a large number of people who lost their job or were stood down during recent lockdowns had stopped searching for work, and so no longer count as participating in the labour market. If these workers were included in the labour force, the figure would be much higher, at around 11%. Looking forward, we expect a strong recovery in the labour market over the next couple of months. By the end of the year, employment and the participation rate are forecast to return to their pre-Delta levels. The unemployment rate is also expected to continue declining to around 4% by late 2023. Let's take a look at wages now. Wages growth has remained relatively weak so far, despite the low unemployment rate. The Wage Price Index, or WPI, which measures changes in the wages of workers, increased by 1.7% over the year to June. Wages growth is expected to increase as economic conditions improve and the labour market tightens. Growth in the WPI is expected to increase to be above 2% by the end of the year. This would be broadly in line with wages growth seen prior to the COVID-19 pandemic. Growth in the WPI is then forecast to reach 3% by 2023. Moving on to inflation. Headline inflation, which is shown in purple, was 3% over the year to the September quarter. Headline inflation in the September quarter was boosted by two specific factors. Firstly, a strong increase in petrol prices due to high global oil prices, and secondly, the increase in the cost of building new homes because of high input costs, such as for timber and steel, and strong demand, in part due to government stimulus programs like the Home Builder Grant. An alternative measure of price pressures in the economy is underlying or trimmed mean inflation, which trims away some of the larger movements in prices. This is shown in blue. This measure of underlying inflation rose to 2.1% over the year to September and is now at its highest level since 2015. Underlying inflation is expected to increase gradually over the next few years, supported by a tighter labour market, stronger wages growth, and increases in other input costs. We expect underlying inflation to remain around 2.25% over the next year or so, before increasing to 2.5% by the end of 2023. The policy measures introduced by the Reserve Bank in response to the pandemic has continued to support the economy. The current policy package includes a record low cash rate target, low-cost long-term funding for the banking system, and a quantity target for asset purchases. One change since our last update is that the board decided at its November meeting to discontinue its target for the April 2024 Australian government bond yield. Together, these policy measures work to lower borrowing rates for households, businesses, and governments, contribute to a lower exchange rate than would otherwise be the case, and support the prices of some assets. The board is committed to maintaining highly supportive monetary conditions in order to achieve a return to full employment in Australia and inflation consistent with the target. For inflation to be between 2 and 3% on a sustainable basis, the labour market will need to be tighter and wages growth materially higher than it currently is. The board will not raise the cash rate until these conditions are met and is prepared to be patient. Thanks for watching this update. A link to the Leitner's Statement on Monetary Policy can be found below. Feel free to explore our website for more information, including some video explainers about key economic issues.